Hello, everyone. I hope you're doing well. Welcome back to the channel. As always, I am not a life insurance agent. I am not an infinite banking practitioner. I am just an IBC enthusiast, and so a lot of what I talk about is essentially just out of pure curiosity for myself, and then also questions that you ask. Please like the video, comment below what you think after you've watched the video here. But today, what we're going to be discussing is the premium flexibility that infinite banking policies offer. Now, one of the main, um, considerations and concerns that many individuals have, including myself when I first got into the infinite banking kind of whole process strategy world, was okay, if I commit to an infinite banking policy that, say, costs $10,000 per year, well, what happens if I can't afford that? What happens if I can only afford half of it at $5,000 a year? Right? And this is a really good question because the idea behind infinite banking is that you have a whole life policy that you want to essentially reduce as much as possible the death benefit, which will maximize the cash value. And so, typically speaking, what you want is you want your base premium to be as low as possible, and your paid up additions rider or option, and my policies are with Equitable, so that's called the EDO payment, to be as high as possible. Now, if you're familiar with US, you'll be looking at a 90-10 split where 10% is base premium and 90% is paid up additions and blah 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 blah. In Canada, there are policies that do this type of thing. However, it's not as common, certainly, as it is in the States. But basically, one of the scenarios, I think the worst case scenario, is what if on your first year you set up the policy, you deposit your $10,000, but then ultimately every year after that you can only fund the $5,000. I think this would be a worst case scenario, save canceling the policy entirely. So let's kind of look at this. So what I've done here is I have pulled a illustration. I've used the same age ratings, everything like that, for both of the illustrations that we're going to run today. This is the illustration, and this is the spreadsheet table that comes with the illustrator. So this is what a quote unquote client would see. And this is what you can look on the back end to get all the fancy numbers that really break down everything, including, the net cost of pure insurance and the taxable gains on surrender and the internal rate of return, not just on cash value, but the death benefit, you name it. So let's look at this, right? You've got your required annual premium of $4,400. And then you've got the total premium you're going to be paying of roughly $10,000. So the difference, roughly $55-ish, $5,600, give or take, is going to be your extra paid up additions. And you'll notice at the end of the first year, you have $7,500 in cash value. You will notice that you've lost roughly 25% of the money that you put into the policy initially, and the break even, practically speaking, sits on the sixth and some would argue the fifth year. In my mind, a 1.4% difference is not a big deal. I wouldn't be too upset if I had to cancel a policy, let's say, and I only lost 1.4%, right? That certainly is a whole lot better than cash getting eroded by inflation over a 5-year period. The same could be said for year 3 and year 4. But anyway, neither here nor there. And you'll notice at the end of 15 years, your internal rate of return is 3.15%. A lot of people compare the internal rates of return to investment returns. There's a whole bunch of considerations there. I'm going to make a whole bunch of videos on this. But a 3% whole life rate of return is not the same as a 3% bank return. And the reason why is because you can access this largely tax-free. It is essentially the internal rate of return on an average rate of return, which does impact things as well. And so it's probably comparable to a 4.5 external rate of return at a 3%. And where you're going to get that with effectively guaranteed returns, it's very, 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 very low. So yeah, So that's how that works. So essentially, right, you've got this policy, and this policy, just so you know, ends up peaking at about a 4% internal rate of return, which is really, really good. It's on the high end, and you can get higher than this, but you essentially have to deposit more premium. Policies become more efficient the larger the premiums that you deposit. Anyway, so what is really interesting about this is now let's go down to where you still got that same 4,400. You still have the same first year $10,000 deposit, but every year after that, we are only depositing the $4,400. You're going to notice the same 24% loss. However, you're going to notice that our losses continue a little bit longer, and the break even technically is in year 9, but again, effectively, I would say it is in year 6, year 7, so slightly longer. And your 15-year internal rate of return is 2.42%, and this policy ends up peaking at about 3.6%. Now, obviously, the top policy is better than the bottom policy. That is without question, hands down, no ifs, ands, or buts about it. Math is math, and clearly the math wins on funding the policy fully throughout the entire history of the policy. However, if you had to choose a internal rate of return of 2.4% to 3.6% is a great, fantastic internal rate of return for money that can be effectively used as, and just like cash in your bank, that continues to compound. The infinite banking process still works at these internal rates of return, because remember, the infinite banking process is not necessarily about the internal rates of return. It's just something that I like looking at. And yeah, so long story short, is your infinite banking process messed up or screwed over if you can only make and deposit one full uh, uh, base premium plus your extra paid up additions premium? No, it's not. And in fact, it can be a viable strategy later down the road. You may do this intentionally if you want to front end load a policy, for example. There's many reasons that you would want to do this willingly and knowingly. And that doesn't necessarily mean it is a bad thing. So, are infinite banking premiums flexible? Clearly. And I don't think that anyone knew the opposite. But you have a tremendous amount of options as time goes by. So if one of your concerns and fears is, what if I can't make the full premium? I hope this makes you feel better. Anyway, let me know in the comments below if you have any questions. If you agree with me, disagree with me, let me know. I just like having a discussion. I don't claim to be a know-it-all on this type of stuff. We've had several commenters that have opened my eyes to many things about the infinite banking world. And if we all have a conversation, we will all become more knowledgeable. I look forward to speaking with you in the comments below. And don't forget to like the video. It really, really helps the channel. Thanks. Bye.